So today we're going to be doing a follow-up video on the one that I posted recently on mortgage shopping. And today we're going to be talking about the loan estimate. And I mentioned in that video that the loan estimate is the document that is the standard in the mortgage industry. And that shows you what type of loan you're getting, how that loan is structured, what you're going to be paying for these, but also what we expect your total out of pocket to be for the whole transaction. There's a lot of details in the loan estimate, and it's not the most consumer-friendly document in terms of being self-explanatory and easy to read. So today we're going to be going through it and pointing out things that you should be looking for and things that are important to pay attention to in the loan estimate. So you can see here on the screen that I'm sharing, we're at the top of the loan estimate, and this should look, at least format-wise, very similar to what you get when you get a loan. You'll see the name of the company, their address, and loan estimate at the top. So date issue tells us when this loan estimate was generated, the name of the person getting the loan estimate. This is an example. I leaned over, is not a real person. Yes, that's a joke. And no, none of these numbers are real. I did put in numbers that I would expect for a transaction like this to look like. However, this is not real pricing, and this is a made-up scenario. So take everything, at least numbers-wise, with a grain of salt. If you have a property already identified and you're in contract, the property address would be here, sale price. And then here at the top, this is the first important section of the loan estimate. So this tells us a few different things that are important. First, how long is the loan? What is the purpose of the loan? What type of product are you getting? Are you getting fixed rate? Are you getting an adjustable rate? Something else maybe? What different type of loan, meaning like conventional, FHA, VA, or something else? And also the rate lock. So all of that is useful information because it shows us what type of loan you're being offered. And is this loan estimate showing you pricing that is protected for a specific period of time? Or is this loan estimate not locked and your pricing is not protected? If this was a real loan and we were looking at a loan estimate that the rate was locked, this box here, yes, would be checked. And next to until, there would be a date and a time of when that loan estimate is good for. So if that box is checked, then your pricing is protected legally through that date. So you see this disclaimer here: before closing, interest rate, points, and lender credits can change unless you lock the interest rate. All other estimated closing costs expire, and then whatever date that gets generated based off of whether the loan is locked or not. And that should be the same on every single loan estimate that is out there. Next, this section is important as well. This shows us how much of a loan you're getting and what interest rate you're getting at. So most of the time, fixed rates are very common, and a lot of this will look very similar. But if you were not being offered a fixed rate loan, some of these will look a little different. So can this amount increase after closing? This is important. So loan with negative amortization, which is very, very uncommon. If you had negative amortization, then that answer would be yes. If you have an adjustable rate loan, this interest rate, can this amount increase after closing? That answer would be yes. And same thing, if either of those two were the case, then monthly principal and interest, that would be able to increase after closing. So if you see fixed rate up the top, the rest of these questions should be no. But if you are not fixed rate, then pay attention here, because one or multiple of these questions will say, yes, this amount can increase after closing. So in this case, we have somebody doing a $400,000 purchase, and she's doing 5% down. This is a placeholder interest rate. And based off of these two, the interest rate and the loan amount, we get the monthly principal and interest. So your mortgage payment includes both of those items. And when it's fixed, the whole number doesn't change. How much goes to each category differs from month to month. Mortgages are interest loaded in the front, That's just the nature of the amortization calculation that our whole entire world uses. Another thing to look out for is prepayment penalties and balloon payments. Most of the time, the answer to these will be no. But if you're getting a loan that is not a conventional FHA or VA loan or USDA, any of the regular conforming loans, then look out for this because the answer might be yes. Next is projected payments. So personally, this is the only part of the loan estimate that I dislike. It's kind of confusing, actually. So when you have a mortgage, you have different things that are all being paid for and accounted for, either together, separate, some combination of those. So obviously we mentioned the mortgage payment, which is the principal and the interest that you're paying every single month. You also have an escrow account, you might have mortgage insurance, and you might have an HOA. So each of those things contributes to your housing expense, but not all of it is wrapped together to show what your total housing expense is on this projected payments section. So we will see all of these numbers added together is what your estimated total monthly payment will be that you're sending to your mortgage company. However, if you have an escrow account, if you have an HOA, then that will not be included in that number because you don't pay your HOA fees to your mortgage servicer. You pay your HOA fees to your HOA. So this is a check that you'll be writing to the mortgage company, but it's not a true indicative factor of what you are actually paying. So estimated taxes, insurance, and assessments, this number includes the HOA fees, it includes the escrow, all of that together. So really, you kind of have to do the math on your own or have your loan officer, loan originator help you to figure out what your total monthly payment is when you also consider the HOA fees, because this document does not add those together for you. Typically, it would just be this number, estimated total monthly payment, plus the HOA fees. And the next section you'll see here is costs at closing. So what is your estimated closing costs and what is your estimated cash to close? This does break down what you're paying in loan costs and other costs. And there's a lot more details on the next page, which is where we'll go next. So closing cost details. The most important part of this, I would say this entire document, is Section A origination charges. So this is actually what you're paying for when you get a mortgage. Typically, can be different names for these fees: underwriting fee, administrative fee, origination fee, processing fee. But basically, they are all just fees that you are paying to your mortgage lender. And additionally, you'll see here, this one is blank, percentage of loan amount points. That is also an additional closing cost that is associated with the loan. So when you're paying points, you are basically paying upfront interest for that loan. So it is considered a closing cost. And if you are paying points, that is listed here. So one of the things I mentioned in my how to shop video is that maybe you're getting this rate that is attractive, it's much lower, but you're paying points to get it. So in order to find that out, you would scroll down to this section, Section A, and you'll see percentage of loan amount points, and you'll see that listed there. Sometimes lenders do charge points as their standard loan fees, but it's not super common. Most of the time you'll see flat fees, and then points would be offered to be charged based off of the pricing for the day for your specific scenario, and what you are able to get and what you would like. So that's important if you're really getting a killer interest rate, but your points adds up to be something very expensive, then you may want to consult your loan professional or even a different loan professional to see if you can make your closing costs a little bit more reasonable. So opposite of points is actually down here, all the way in Section J, lender credits. So the opposite of a point is a credit. They're typically also based off of the loan amount. And if you are getting a lender credit, you will find that here. So it's not as common in our market these days, but lender credits typically are like the opposite of a point. So you would theoretically take a higher interest rate, and then in exchange, you get a lender credit, which can pay down some of your closing costs. When interest rates are in a rising environment, it's a lot harder to get lender credits in pricing. So Section B, services you cannot shop for. So you see the appraisal fee is listed here. You can't shop for your appraisal. You can get one on your own separately. But if your loan requires you to get an appraisal, then you have to go through the lender for that appraisal. So Section C, services you can shop for. This is a little bit misleading because we put a lot of the title fees here. And at least when we get a purchase contract here in Florida, the title company is already chosen. So many times the seller picks the title company. And if that's the case, then you've already kind of given up your opportunity to shop for those services. With a refinance, typically it's easier to shop for a title company if you want to. Most people don't though. But if you do want to shop, technically you could. It's just that by the time you're getting the loan estimate, most of the time it's already decided who's going to be the title company or the real estate attorney who is doing that transaction. And you'll see total loan costs, $6,054. So that adds these numbers together here. And some of the title fees are connected to the loan, but others you would have to get regardless of whether or not you're getting a loan. For instance, a survey, you're probably going to have to get one for the title process. Settlement fees, stuff like that. So next is other costs. If there's any transaction taxes, that's where they will appear there. And typically we figure out what those are going to be when we submit your loan estimate to you. They can vary, especially by area. Most of the state of Florida is the same calculations. Miami-Dade is a little bit different, a little bit more expensive, but the rest of Florida is the same. And then different states and counties outside of Florida have their own rules. And we would find that out when we provide the loan estimate for you. Prepaids. So prepaids encompasses everything that you're paying for, that you're getting benefit from it after you've paid for it. So homeowners insurance premium, when you pay your homeowners insurance policy at closing, you are getting that insurance coverage for a full year after closing. So it does need to be paid up front. That is required. It is considered a closing cost, however. Also prepaid interest. So from the date of your closing date to the end of the month, that is interest that you have to pay. And the reason for that is interest on mortgages is paid in arrears, which basically means, say you have a mortgage payment in December, the interest on that is paying for November. So by the time you get your first payment, a whole month will have already passed. And then whatever month you're paying that mortgage payment in, you're paying for the previous month's interest. So having that prepaid interest from the point of closing to the end of the month, that allows us to have that set up properly. And you're still being charged interest for every single day that you have that loan. So next is initial escrow payment at closing. You'll see here homeowners insurance is listed again. And the reason for that is it still has to go in the escrow. So typically we do have to load at least a few months of homeowners insurance and property taxes into that escrow account, because the reason for that escrow account is to avoid payment shock. So each of those items needs to be paid once a year, and we don't want to have somebody have to pay $4,000 for their insurance policy when really we were not calculating that they needed to get reserves. So especially lower down payment loans, you're going to be required to get an escrow account, and that has to be set up at closing. Even though you're paying that 12 months of homeowners insurance, it still needs to get put in there for the off chance that your homeowners insurance goes up the following year. You still have to have that money in the account. Also, property taxes, how much you will need to put in your account will depend on the property taxes for that home and also when you are closing. Next is other, which is here we have owner's title insurance, which is another title fee. It is technically optional, but most people end up getting a title insurance policy. When you add all of these together, you'll see total closing costs, $17,293. And that sticker number might sound a little scary. It might sound high, but think of all the things that you're paying for. Most of, a lot of this is just paying for property taxes and homeowners insurance, which you would have to pay as maintenance costs for owning that home. So really, a lot of these things are fees that are required to kind of jump and kickstart the process of you owning that home. And that is definitely an important thing to consider. A lot of these are startup costs. And you may think, oh, this lender has much lower closing costs than somebody else. This number is misleading for that reason, because let's go back here. Your loan origination charges, your loan costs, that's actually what you're paying for in closing costs to the lender. So Section A, and to a lesser extent, Section B, is things that we are in control of. However, all of the rest of this stuff, they would be the same regardless of who does your loan. So that is very important to consider when you are shopping for a loan and comparing different loan estimates. So this is where we get calculating cash to close. And then this just adds all of these different line items together and subtracting if they're negative, and then we get your estimated cash to close. And again, this is an estimate because a lot of this stuff we don't know upfront. We don't know really any title fees upfront, because we almost always send a loan estimate within within 3 days, usually within a day or two of you getting into contract on a home. So we don't have that information right away. That's something we find out into the process. Same thing with homeowners insurance. So again, this is estimate. These things could change if this were a real scenario. Down payment, that's self-explanatory. That's the initial equity you put in at closing to the home. And then we see seller credit here. So I did put a seller credit just to showcase what that would look like. If this person did not get a seller credit, then this would be $37,293. The next page has a lot less information, but it is still a little bit interesting to look at. You'll see comparisons of what you're going to be paying in 5 years and how much of that is principal, how much of that is other stuff. Your APR is on this page, total interest percentage. The reason why these numbers are higher compared to the amount of principal you're paying off is because interest is front-loaded on mortgages. And I can make a video about that in the future if you guys are interested. Other considerations, this section tells us a few different disclaimers. One about your appraisal, loan assumption, which is not relevant in most cases, but if you're getting an FHA loan or a VA loan, there are certain circumstances where you were able to have somebody else assume that loan. Homeowners insurance is required. What happens when your payment's late? Refinancing will depend on your future financial situation. You may not be able to refinance this loan, that disclaimer, and then also servicing. So whether or not we intend to transfer servicing of your loan after you close. And then this is the section where you sign. And once that is signed, then we are actually able to start working on your loan. So that's the loan estimate video. If you guys have any questions, please leave them down below, and I'm happy to help